There is a secret language in the world of finance, a language not spoken in numbers or charts, but in feelings, memories, and habits. It's a language that explains why you'll pay $5 for a cup of coffee you could make at home for 50 cents, why you'll choose one specific soft drink out of a dozen options without a second thought, and why the logo on a simple handbag can multiply its price by a factor of 100. Most investors, even seasoned professionals, are deaf to this language. They spend their lives analyzing spreadsheets, dissecting cash flow statements, and building complex valuation models. They see businesses as collections of factories, patents, and inventory. But Warren Buffett, the man who built a $250 billion empire from the ashes of a failed textile mill, is fluent in this other language. He understands that the most valuable asset a company can own is not something you can touch or count. It is a piece of real estate in the human mind. This understanding is the key to his entire philosophy, the single greatest competitive advantage he has deployed over a 6-decade career. He looks for businesses that have built an unbreachable fortress, not of bricks and mortar, but of customer loyalty. An economic moat so deep and wide that competitors drown trying to cross it. And the foundation of this moat, the bedrock upon which all of it is built, is a powerful, enduring brand. What we are about to embark on is a deep deconstruction of this principle. We will not just admire Buffett's wisdom, we will steal his playbook. You will learn to see the world through his eyes, to identify the invisible assets that create companies that don't just earn money, but print it. You will understand how to avoid the single most costly mistake in modern investing: underestimating the raw financial power of a name, a logo, a feeling. By the end of this journey, you will possess a new framework for financial analysis, a mental model that will allow you to spot the handful of truly great businesses that can compound your wealth for decades, weathering any economic storm, and securing a level of financial freedom that the spreadsheet jockeys can only dream of. This is the ultimate competitive advantage, not just for the companies that possess it, but for the investors who are smart enough to identify it. The journey begins not in a boardroom on Wall Street, but in a small, unassuming candy shop in California. This is the first and perhaps most important lesson in Buffett's masterclass on brand value, a story that fundamentally rewired his investment brain. The year was 1972. Warren Buffett and his partner Charlie Munger were considering buying a company called See's Candies. On the surface, it was an unimpressive business. It was a family-owned chain of candy shops, concentrated almost entirely in California. Its tangible assets were meager: some retail leases, some basic kitchen equipment for making chocolates, and a bit of inventory. By any conventional metric of value investing, the kind taught by Buffett's own mentor, Benjamin Graham, the asking price was absurd. The See family wanted $30 million. The company's net tangible assets, the hard stuff you could sell off in a liquidation, were only about $8 million. This meant Buffett and Munger were being asked to pay a $22 million premium for something that didn't technically exist on the balance sheet. They were being asked to pay for reputation, for nostalgia, for the See's Candies name. Munger was immediately intrigued. He understood the power of the brand. Buffett, still a stricter disciple of Graham's cigar butt approach of buying statistically cheap companies, was hesitant. Paying nearly 4 times book value for a candy company felt like a betrayal of his quantitative roots. As he later said, "If we'd had to pay the $30 million the See family was asking, we would not have bought it." Their initial offer was $25 million, all they were willing to pay. The family, wanting 30, rejected it. For a moment, the deal was dead. And in that moment, Buffett was about to make one of the biggest mistakes of his career, not by overpaying, but by walking away. It was Munger who pushed him. He convinced Buffett that they were not just buying kitchens and stores, they were buying an institution. See's Candies occupied a special place in the hearts of Californians. For decades, it was the go-to gift for birthdays, for Valentine's Day, for Christmas. Giving a box of See's was a gesture of quality and affection. Customers didn't just buy the chocolates. They bought the feeling of tradition and the certainty of a smile on the recipient's face. This loyalty gave See's an extraordinary power. the power to raise its prices year after year without losing its customers. People were not buying chocolate based on a cold calculation of cocoa content per dollar. They were buying C's. Reluctantly, Buffett agreed. They went back to the sellers and paid the $25 million. It was a pivotal moment. It was the first time Berkshire Hathaway had paid a significant premium for intangible value for a brand. The results were a revelation. In their first year of ownership, C's earned about $2 million after tax. Decades later, that same little candy company, without massive capital investment, was generating over $80 million a year in pre-tax profit. The initial $25 million investment has since delivered over $2 billion in earnings to Berkshire Hathaway. It became what Buffett calls a dream business. It gushed cash, requiring very little in return. That cash was then used to buy other incredible businesses. C's Candies was the financial engine, the down payment, for much of the Berkshire empire that followed. The lesson was seared into Buffett's mind. The $22 million premium they paid for the invisible asset was, in fact, the greatest bargain of all. The $8 million in tangible assets was the least important part of the business. He learned that a truly great business, one with a powerful brand at its core, had an economic reality that defied the neat columns of an accounting statement. This single transaction shifted him from buying fair companies at wonderful prices to buying wonderful companies at fair prices. And the definition of a wonderful company became one that owned a piece of its customers' minds. The magic of C's Candies, the force that allows a simple box of chocolates to generate billions in profit, isn't cooked up in its kitchens. It's manufactured in the intricate wiring of the human brain. The underlying psychological principle at play is a powerful combination of two cognitive biases, the halo effect and the affect heuristic. These mental shortcuts are the invisible architects of brand loyalty. The halo effect is a cognitive bias where our overall impression of a person, or in this case a brand, influences how we feel and think about their specific traits. If we have a generally positive impression of a brand, we will assume its products are of high quality, its prices are fair, and its service is good, often without any direct evidence. Think about Apple. For millions, the Apple brand has a powerful halo of innovation, elegant design, and user-friendliness. Because of this halo, when Apple releases a new product, be it a phone, a watch, or even a polishing cloth for a shocking price, customers are predisposed to believe it is the best in its class. They aren't just evaluating the product's technical specifications, they are filtering those specifications through the positive glow of the Apple brand. The brand itself is a proxy for quality. C's Candies cultivated this same effect over decades. The clean black and white checkered stores, the friendly uniformed staff offering a free sample, the nostalgic connection to family celebrations, all of these elements created a powerful positive halo. When a Californian thought of C's, they didn't just think of chocolate, they thought of quality, tradition, and happiness. This halo allowed C's to command a premium price. A customer wasn't just buying ingredients. They were buying the assurance of quality that the brand's halo provided. Competing on price was impossible for a rival, because they weren't just competing against C's chocolate, they were competing against decades of happy memories. Closely related is the affect heuristic. This is a mental shortcut that allows us to make decisions quickly and efficiently by relying on our current emotions. The word affect is the psychological term for the subtle feeling of goodness or badness we associate with something. When we make a judgment, we often subconsciously ask ourselves, how do I feel about this? If we have a positive feeling, we perceive the risks as low and the benefits as high. If we have a negative feeling, the opposite is true. Great brands are masters of managing our affect. Coca-Cola is the quintessential example. For over a century, their marketing has had almost nothing to do with the specifics of their beverage. Instead, it has been a relentless campaign to associate Coca-Cola with positive emotions, happiness, friendship, family, celebration, nostalgia. Their Share a Coke campaign didn't list ingredients, it put your name on the bottle, creating a personal, positive, emotional connection. The result is that when you're standing in front of a vending machine, the choice is not a rational one. Your brain doesn't conduct a microeconomic analysis of price versus refreshment. It taps into the affect heuristic. The thought of Coke triggers a faint, pre-programmed echo of happiness. The thought of a generic cola triggers nothing. The decision is made in an instant, driven by emotion, not logic. This is the financial power of the affect heuristic. It short-circuits rational price comparison. It creates a default choice. It's why Coca-Cola can sell billions of servings of sugar water at a massive markup, year after year. For C's, the affect was one of warmth, generosity, and tradition. Buying a box of C's feels good. It's a safe, reliable choice that you know will be well received. That positive affect removes the friction from the purchase decision and makes the price a secondary concern. Buffett understood this intuitively. He realized that these companies weren't just selling products, they were selling emotional shortcuts, they were selling a feeling of certainty in an uncertain world. And that feeling, that invisible asset built on psychological principles, was the most durable and profitable asset of all. So how do we, as investors conducting our own business analysis, translate this theory into a practical tool? How do we move beyond simply admiring Buffett's insight and start applying it to our own stock picking and portfolio growth? The answer lies in creating a systematic mental model, a blueprint for auditing the intangible value of a brand. Let's call it the Brand Intangible Asset Audit. It consists of 5 distinct tests that force you to look beyond the numbers and probe the true strength of a company's connection with its customers. The first step is the nostalgia test. This is a simple but profound question. Does the brand evoke strong, positive memories for a large and demographically significant group of people? A brand that is woven into the fabric of a person's childhood has a staying power that is almost impossible for a competitor to replicate. Think of the Walt Disney Company. For generations, its characters and stories have been a foundational part of growing up. This deep-seated nostalgia creates a lifelong bond. Parents who grew up with The Lion King are now eager to share that experience with their own children, creating a virtuous cycle of loyalty. The same is true for a brand like Hershey's. The taste of a Hershey's Kiss is, for many Americans, inseparable from memories of holidays and family. A new chocolate company could create a product that tastes objectively better, but it cannot create the memories. When you audit a company, ask yourself, is this a brand people will introduce to their kids? If the answer is yes, you may have found a powerful intergenerational moat. The second step is the no substitute inquiry. Imagine the brand vanished from the earth tomorrow. Would its customers be genuinely upset? Would their lives be meaningfully inconvenienced? Or would they simply shrug and switch to the next available option without a second thought? This question separates true brands from mere products. If your local gas station disappeared, you would simply drive to the one across the street. But if the iPhone disappeared, its millions of users would feel a genuine sense of loss. They would lose their ecosystem of apps, their seamless integration with other devices, their social identity. The switching costs are not just financial, they are emotional and procedural. A great business analysis involves identifying high switching costs. When a customer feels that there is no adequate substitute, the company has immense power. That is the essence of a brand-based economic moat. The third test is the gift-giving standard. Is this a brand that people are proud to give as a gift? The act of giving a gift is loaded with social and emotional significance. We choose gifts that reflect not only on the recipient, but also on ourselves. Giving a gift from a premium, trusted brand is a low-risk way to signal taste, care, and generosity. This is why Tiffany & Company can sell a silver necklace for 10 times the price of an identical one from a department store. People are not just buying the silver, they are buying the iconic blue box and the message it sends. The same is true for a high-end bottle of scotch, a luxury watch, or even a box of C's candies. When a brand becomes a go-to choice for gift-giving, it has achieved a level of trust and perceived quality that insulates it from price competition. When evaluating a company, look at its role in the gifting economy. Is it a brand people use to express their most important sentiments? The fourth step is the geographic concentration test. This is directly inspired by the See's Candies story. Does the brand have an almost irrational level of dominance in a specific city, state, or region? This suggests that the brand has transcended being a mere product and has become part of the local culture. In Texas, there are grocery store chains like H-E-B that inspire a cult-like devotion that outsiders find baffling. In the Pacific Northwest, there are regional banks or coffee shops that have a level of customer loyalty that national chains can't break. This deep-seated local dominance is often a sign of a powerful, culturally embedded brand that has been built over decades. It's a fantastic starting point for identifying companies with a hidden, powerful moat before they expand nationally or globally. Finally, the fifth step is to connect this qualitative analysis back to the financial statements by calculating the goodwill. When one company acquires another, the price it pays above the fair market value of the tangible assets is recorded on the balance sheet as goodwill. In essence, goodwill is the accounting world's clumsy attempt to put a number on the very intangible assets we've been discussing: brand reputation, customer relationships, intellectual property. When you see a company like Berkshire Hathaway or a large consumer goods conglomerate make an acquisition, look at the amount of goodwill created. A massive goodwill figure can sometimes be a red flag for overpayment. But when it's a savvy capital allocator buying a company with a legendary brand, that goodwill figure is a clue. It is a tangible admission that the real value of the business lies in the invisible fortress of its brand. By applying this five-step audit, you move beyond being a passive consumer of financial data and become an active investigator of brand value, emulating the very thought process that allowed Buffett to turn a small California candy company into a $2 billion lesson in long-term investing. The path to identifying these incredible brand-driven businesses is a lonely one, precisely because it requires swimming against the powerful current of conventional thinking. To understand why Buffett's approach is so effective, we must dedicate time to deconstructing the opposite approach, the path that 99% of investors follow, often to their own detriment. This is the path defined by the tangible asset trap. The average investor, and indeed many so-called professionals, are fundamentally uncomfortable with ambiguity. They crave certainty. They want to anchor their investment decisions to things they can see, touch, and quantify. They look at a balance sheet and are drawn to the lines that say property, plant, and equipment, or inventory. They calculate a company's book value, its theoretical liquidation value, and use that as their primary benchmark for what a company is worth. If a stock is trading at or below its book value, it feels safe, it feels cheap. If it's trading at a high multiple of its book value, as companies with powerful brands often do, it feels risky and overvalued. This mindset would have led them to look at See's Candies in 1972 and come to a swift conclusion. Paying $30 million for $8 million in tangible assets is madness. They would see the candy-making machines, the delivery trucks, and the retail storefronts. They would assign a value to those things. They would completely miss the $22 million asset that truly mattered, the brand's real estate in the minds of Californians. The tangible asset trap leads investors into industries that are, by their very nature, terrible businesses. Consider the airline industry. Investors are drawn to it because the assets are enormous and obvious. Airlines own billions of dollars worth of airplanes. You can see them, touch them, track their tail numbers. It feels like a solid, asset-rich business. But as Buffett has famously quipped, if a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville Wright. He would have saved his descendants a lot of money. The airline business is a brutal, capital-intensive commodity business. For the most part, customers choose flights based on two factors: price and schedule. There is very little brand loyalty. A passenger will switch from United to Delta to save $20 without a second thought. This lack of loyalty means the airlines have no pricing power. They are in a constant, bloody price war with one another, a race to the bottom that annihilates profitability. The massive tangible assets they own are not a source of strength. They are a boat anchor, requiring colossal and constant capital expenditures for maintenance and replacement. The investor trapped by the tangible asset mindset sees the planes and thinks value. The Buffett-style investor sees the lack of brand loyalty and thinks trap. This same flawed logic applies to many other industries. Basic manufacturing, mining, oil and gas exploration, and even some areas of retail are filled with companies that have huge tangible assets but zero competitive advantage. They produce commodity products that are indistinguishable from their competitors. The only way they can compete is on price. This is a terrible game to play, and an even worse one to invest in. The financial consequences of this path are devastating. The investor who falls into the tangible asset trap ends up with a portfolio of value traps, companies that are statistically cheap for a very good reason. They own businesses that are constantly fighting for survival, that get squeezed during economic downturns, and that rarely, if ever, generate the kind of excess cash flow needed for sustained dividend growth and long-term compounding. They mistake a cheap stock price for a good business, when in reality, the price is a reflection of a fundamentally broken business model with no durable competitive advantage. They are so focused on the price of everything that they fail to see the value of anything. They are deaf to the secret language of brands, and their portfolio performance reflects it. They have chosen the illusion of safety in tangible assets over the reality of profitability in intangible ones, and in the long run it is a choice that leads to mediocrity and frustration. The connection between a powerful brand and a company's financial performance is not abstract or theoretical. It is a direct, quantifiable, and explosive force that appears on every line of the financial statements, from the top to the bottom. Understanding this connection is what separates a business analyst from a mere speculator. It is how you translate the warm, fuzzy concept of customer loyalty into the cold, hard reality of cash flow. Let's start at the top with the income statement. A company with a strong brand and pricing power will almost always have superior gross margins. Gross margin is the percentage of revenue left after subtracting the cost of goods sold. A company in a brutal, commodity-like business might have gross margins of 10 or 20%. They have to spend 80 or 90 cents on inputs for every dollar of sales. But a company with a dominant brand, like a luxury goods maker or a dominant software company, can have gross margins of 60, 70, or even 80%. They can sell a product for $1 that only cost them 20 cents to make. This massive difference is a direct financial manifestation of the brand's value. The brand allows them to charge a premium price that is completely disconnected from their input costs. They don't have to engage in price wars, which protects those lush margins year after year. Next, a strong brand dramatically lowers a company's operating expenses, specifically sales and marketing costs. Think about a new company trying to break into a market. They have to spend enormous amounts of money on advertising and promotion just to get customers to notice them. This is their customer acquisition cost, or CAC. For a dominant brand, the brand itself does the heavy lifting. The brand is a magnet. People already know it, trust it, and seek it out. While they still spend on marketing, that spending is more about reinforcing existing loyalty than desperately trying to create it from scratch. This means a lower percentage of their revenue is spent on customer acquisition, allowing more profit to fall to the bottom line. Coca-Cola's marketing budget is huge in absolute terms, but the brand's power ensures that every dollar spent is incredibly effective at maintaining its global dominance. But the most profound impact is on the balance sheet and the statement of cash flows. As we discussed with See's Candies, the accounting value of a brand often appears as goodwill or intangible assets. While accountants struggle to value it precisely, its economic effect is crystal clear. A business with a powerful brand is often a capital-light compounder. See's Candies, for example, did not require massive, ongoing investments in factories or research and development to grow its earnings. Its growth came from its ability to consistently raise prices on its existing products. This created a gusher of free cash flow. Free cash flow is the cash a company generates after accounting for the capital expenditures necessary to maintain and grow its asset base. It is the excess cash that can be used to pay dividends, buy back stock, or acquire other businesses. Businesses with powerful brands are often free cash flow machines. The brand is an asset that appreciates in value without requiring much capital investment. Contrast this with a capital-intensive business like a railroad or a utility. They have to reinvest a huge portion of their earnings back into the business just to stay competitive, leaving little free cash flow for shareholders. This is why Buffett loves businesses like Sears or Coke. They take very little from him, but give him mountains of cash in return. That cash, generated by the power of the brand, is then deployed to buy other wonderful businesses, creating the compounding engine that is Berkshire Hathaway. Let's quantify this. Imagine a company with $100 million in revenue. Company A is a commodity business with a 20% gross margin and needs to reinvest 80% of its profits to stay competitive. Company B is a brand-driven business with a 60% gross margin and needs to reinvest only 20% of its profits. The difference in free cash flow is not just a few percentage points. It's a chasm. Company B will generate exponentially more cash for its owners over time. This is the ultimate financial connection. A great brand allows a company to charge more, spend less on marketing, and reinvest less capital for growth. This is the holy trinity of financial performance. It creates a torrent of free cash flow that, when held for the long term, translates directly into spectacular portfolio growth and a rising stream of dividend income for the intelligent investor. The act of building a brand that inspires unshakable loyalty is a delicate, multi-generational art form. It's about creating a promise and then delivering on that promise, millions of times without fail, until it becomes an ingrained belief in the mind of the consumer. One of the most dramatic and telling examples of this principle in action, a moment that revealed the true source of a brand's power, is the story of the American Express salad oil scandal of 1963. At the time, Warren Buffett was a young, relatively unknown money manager, but he was the largest single shareholder of American Express. A key, but obscure, part of Amex's business was its warehousing division. They would certify the contents of storage tanks for other companies, and those companies would then use that Amex-certified receipt to get loans from banks. It was a business built entirely on one word: trust. A company called the DeAngelis Tallow Company was a major client. They borrowed heavily against their inventory of salad oil, which was held in large tanks in Bayonne, New Jersey, all certified by American Express. The scandal broke when it was discovered that the mastermind, Tino DeAngelis, had perpetrated a massive fraud. The tanks were filled mostly with seawater, with only a thin layer of salad oil on top. The collateral that banks thought they had was worthless. DeAngelis defaulted, and the banks were facing catastrophic losses on the order of $60 million, a colossal sum at the time. Pandemonium erupted. American Express's stock price was sliced in half. Wall Street assumed the company was ruined, that the liabilities from the fraud would bankrupt it. The crucial point, however, was that American Express had no direct legal liability. Their contracts were written in a way that protected them. They could have walked away, letting the banks take the loss, and legally they would have been in the clear. Many on the board wanted to do just that. But Buffett saw the situation differently. He didn't see a legal problem, he saw a brand problem. He knew that the value of American Express was not in its travelers' check processing centers or its office buildings. The entire enterprise was built on the promise of absolute integrity and trust. If a piece of paper had the American Express name on it, it was supposed to be as good as gold. If they were to hide behind legal technicalities and let their partners suffer, that promise would be shattered. The brand would be permanently tarnished. He did his own scuttlebutt research. He went to banks, restaurants, and travel agencies, talking to employees and customers. He observed that people were still using their travelers' checks and credit cards. The scandal hadn't yet shaken the faith of the end consumer. He realized the core business was still strong, but only if the company acted decisively to protect its reputation. He aggressively bought more stock as it plummeted and met with the CEO, Howard Clark, urging him to do the honorable thing. In the end, Clark and the board made a courageous and brilliant decision. They publicly announced that even though they were not legally obligated to, American Express would stand behind its name and make good on the losses. It was a massive financial hit, costing them tens of millions and wiping out a significant portion of their net worth. In the short term, it was excruciatingly painful, but in the long term, it was one of the greatest brand-building investments in corporate history. That single act cemented the American Express brand as the gold standard for trust and financial integrity. It sent a message to the entire world: our name is our bond, and we will pay any price to protect it. The stock, which Buffett had bought at a panic-induced low, soared in the following years, making him a fortune. The lesson was profound. The most valuable asset was the public's trust, and that asset had to be protected at all costs, even if it meant sacrificing short-term profits. A brand is not just a logo, it's a promise. And the companies that understand this, and are willing to pay dearly to uphold that promise, are the ones that build moats that last for a century. The unwavering loyalty that American Express fostered by honoring its name, even at great cost, is not an accident of commerce. It is a calculated, albeit perhaps intuitive, exploitation of deep-seated human psychology. The two principles that form the bedrock of this kind of fierce brand loyalty are the commitment and consistency bias and the power of social proof. These biases are not signs of weakness. They are essential cognitive shortcuts that allow us to navigate a complex world without having to reevaluate every single decision we make from first principles. Great brands understand this and weave their story directly into this mental architecture. The commitment and consistency bias describes our deep psychological need to be, and to appear, consistent with what we have already done. Once we make a choice or take a stand, we encounter personal and interpersonal pressures to behave consistently with that commitment. To do otherwise would create a state of mental discomfort known as cognitive dissonance. When a customer chooses a brand for the first time, they have made a small commitment. They have chosen Apple over Android or Nike over Adidas. To reduce the potential for post-purchase regret, their brain immediately begins to work to justify that decision. They will start to notice more of the brand's positive attributes and ignore its flaws. They will seek out information that confirms their choice was the right one. The brand is no longer just a product, it has become a small part of their identity. Each subsequent purchase deepens this commitment. The more you use a product, the more integrated it becomes into your life, and the more invested you are in the idea that you made the right choice. This is why it's so difficult for people to switch operating systems, banks, or even their preferred brand of toothpaste. The act of switching is not just a practical inconvenience, it is an implicit admission that all of your previous choices were wrong. The human ego finds this incredibly difficult to accept. American Express's decision in the salad oil scandal was a masterstroke in leveraging this bias. By making a massive, public commitment to the principle of trust, they forced the world to see them as consistent with that ideal. In turn, their customers, who had already committed to using Amex products, felt a wave of validation. Their choice was a good one. This reinforced their loyalty and made them even more committed to the brand, creating a powerful feedback loop of consistency. The second pillar is social proof. This is the tendency to see an action as more appropriate when others are doing it. It's a fundamental survival instinct. If everyone else is running away from something, you should probably run too. In the world of commerce, social proof is a powerful driver of adoption and loyalty. When we are uncertain about a decision, we look to others for cues. When we see our friends, colleagues, or people we admire using a particular brand, it serves as a powerful endorsement. It lowers the perceived risk of making the wrong choice. The white Apple earbuds that were ubiquitous in the early 2000s were not just a design feature, they were a brilliant marketing tool that made the brand's popularity visible. Every person wearing them was a walking billboard, providing social proof to everyone they passed. Starbucks became a global phenomenon, not just because of its coffee, but because carrying a Starbucks cup became a social signal, a marker of being a busy modern professional. It was visible proof of the brand's tribe. A company that creates a product that its users are proud to display is harnessing the power of social proof. This builds a powerful sense of community and belonging. Leaving the brand doesn't just mean giving up the product, it means leaving the tribe. This is why Harley-Davidson can sell merchandise at a huge premium. People are not just buying a leather jacket, they are buying admission into a community, a visible sign of their social identity. These two psychological forces, commitment and consistency and social proof, work together to create an incredibly sticky customer base. The initial choice is often influenced by social proof, and then the commitment bias locks that choice in, creating a loyal customer who not only continues to buy, but also actively resists information that contradicts their decision. This is the psychological mechanism behind a brand-based economic moat. It is a fortress built not of stone, but of cognitive biases, and it is often far more durable. To consistently identify companies that have successfully hijacked these psychological triggers, we need a practical, repeatable process. We need a mental model for auditing the stickiness of a customer base. Let's call it the loyalty loop audit. This audit moves beyond simple customer satisfaction surveys and digs into the behavioral mechanics that create truly durable brand loyalty. It consists of 4 critical inquiries. First, you must identify the habit trigger. A product or service that becomes part of a daily or weekly ritual develops a level of stickiness that is almost unbreakable. The goal is to determine what specific event, time of day, or emotion triggers the use of the product. For millions, the morning alarm is a trigger for a cup of Folgers coffee at home or a trip to Starbucks on the way to work. The 3 p.m. energy slump is a trigger for a Coca-Cola or a Kit Kat bar. The end of a stressful day is a trigger to open Netflix. When a brand becomes the default solution to a recurring trigger in a customer's life, it has moved beyond a simple choice and has become a habit. The cognitive load required to choose a competitor becomes a significant barrier. When analyzing a business, map out the customer's day and identify where the brand fits. Is it an occasional, considered purchase, or is it an automatic, habitual response? The latter is infinitely more valuable. The second step is to analyze the true switching costs. We often think of switching costs in purely financial terms, but the most powerful ones are often procedural, emotional, or psychological. For example, the financial cost of switching from one social media platform to another is 0. But the procedural and emotional costs are immense. You would have to rebuild your network of friends, re-upload years of photos, and learn a new interface. More importantly, you would lose your digital history and social connections. The pain of disconnection is the real switching cost. When evaluating a business, particularly in technology or services, ask, what is the real pain a customer would have to endure to leave? For a bank, it's the hassle of changing direct deposits and automatic payments. For an enterprise software company, it's the cost of retraining an entire workforce. For a brand like Apple, it's leaving the seamless ecosystem where your phone, laptop, and watch all work together effortlessly. The higher and more multifaceted the switching costs, the deeper the moat. The third element is to map the social proof signals. In our modern, visually driven world, the most powerful marketing is often user-generated and publicly visible. You need to identify how and where the brand's popularity is displayed. Is it a logo on a t-shirt, like Nike's swoosh? Is it a distinctive product design, like the shape of a Porsche 911? Is it a piece of professional equipment that signals expertise, like a specific brand of camera used by photographers? These visible signals turn every customer into a brand ambassador. They create an ever-present layer of social proof that constantly reinforces the brand's status as a desirable and popular choice. A business whose product is used in private has a much harder time generating this effect than one whose product is used in public. Look for brands that have created a tribe, and then look for the visible artifacts that identify a member of that tribe. The final and perhaps most crucial inquiry is to evaluate the pain of disconnection. This goes beyond switching costs and touches on identity. Does leaving the brand feel like a social downgrade? Does it mean leaving a community that you value? This is the highest level of brand loyalty. A person who sells their Harley-Davidson is not just getting rid of a motorcycle. They are, in some ways, leaving the Hog Harley Owners Group community. A student who switches from a MacBook to a Windows laptop on a creative campus might feel a sense of social exclusion when a brand becomes intertwined with a customer's self-image and their social circle. The moat becomes almost absolute. The brand is no longer something they use, it is part of who they are. To abandon the brand would be to abandon a piece of their own identity. By systematically applying the loyalty loop audit, you can move from a superficial understanding of a brand to a deep psychological analysis of its durability. It helps you distinguish between a company that has merely rented its customers' attention and one that truly owns a permanent space in their habits, routines, and identity. The world is littered with the corpses of companies that were once wildly popular. This corporate graveyard serves as a stark warning against the antithesis of Buffett's approach, the dangerous allure of chasing fads and trends. The average investor, driven by a fear of missing out and a constant bombardment of financial media, often confuses temporary popularity with a durable brand moat. They see a company with a hot product and soaring sales, and they pile in, assuming the growth will last forever. But they fail to ask the critical question: is this loyalty built on a deep psychological foundation, or is it built on the shifting sands of novelty? A fad is a product or company that experiences a rapid, intense surge in popularity, often driven by hype, social media, or a unique gimmick. Think of trends like fidget spinners, the early mania for Groupon, or the flash-in-the-pan success of certain mobile games. These companies can look incredibly successful for a short period. Their revenue growth is explosive, and their stock prices can go parabolic. Investors who jump on board feel like geniuses. The problem is that fads are, by their nature, ephemeral. Their appeal is based on newness. Once the novelty wears off, and the culture moves on to the next new thing, the customer base evaporates almost overnight. The company is left with a product nobody wants and a business model that is no longer viable. The investor who chased the fad is left holding a stock that is in a permanent nosedive. A truly great brand, in contrast, is often the opposite. Its growth may be slower, more methodical. Its appeal is not based on novelty, but on timeless qualities like trust, consistency, quality, and identity. A fad is like a firework, a spectacular, brief explosion of light and noise. A great brand is like a mighty oak tree. It grows slowly, sinks its roots deep into the culture, and endures for centuries. The story of BlackBerry, formerly Research in Motion, is a perfect case study. In the mid-2000s, BlackBerry was not just a product, it was a phenomenon. Its physical keyboard and secure email service made it the indispensable tool for business executives and politicians. It had a catchy nickname, Crackberry, that spoke to its addictive, habit-forming nature. By all superficial measures, it seemed to have a powerful moat. But the moat was built on a specific technological solution, not on a deep emotional connection. Its loyalty was conditional. When Apple launched the iPhone in 2007, it offered a fundamentally better, more versatile user experience. BlackBerry, complacent in its dominance, failed to adapt. Its customers, who were loyal to the function of the device, not the BlackBerry brand itself, switched en masse to the iPhone and later to Android devices. The Crackberry addiction was cured almost overnight. The company went from market leader to irrelevance in just a few short years. Investors who mistook its temporary technological advantage for a permanent brand moat were decimated. The path of the 99% is to constantly scan the horizon for the next firework. They chase returns, buying what's hot and selling what's not. This strategy is exhausting, expensive due to taxes and trading costs, and ultimately rarely successful. It requires you to be right twice. You have to know when to get in, and you have to know when to get out before the inevitable collapse. Buffett's path is to ignore the fireworks and search for the oak saplings. He looks for businesses whose appeal is not tied to a specific trend or technology, but to a fundamental and enduring human need or desire. He knows that fads create temporary stock price spikes, but great brands create permanent wealth. The direct financial translation of a fiercely loyal customer base is a predictable, recurring, and growing stream of revenue. In the world of financial analysis, this is the holy grail. It transforms a company's valuation from a speculative bet into something resembling a high-yield bond. The key metrics that reveal this dynamic are churn rate and lifetime customer value, LTV. Churn rate is the percentage of customers who stop using a company's product or service over a specific time period. A company with a weak brand and low switching costs will have a high churn rate. They are constantly losing customers and must spend heavily on sales and marketing to replace them, just to keep their revenue flat. It's like trying to fill a leaky bucket. This is the reality for many wireless carriers, insurance companies outside of unique models like Geico, and retailers selling non-differentiated goods. A company with a powerful, habit-forming brand will have an exceptionally low churn rate. Their bucket has very few leaks. Customers stick around for years, even decades. This creates an incredibly stable and predictable revenue base. Think of a company like Intuit, the maker of QuickBooks and TurboTax. For a small business, the idea of switching their entire accounting system from QuickBooks to a competitor is a nightmare. The procedural switching costs are enormous. For an individual, the thought of using a different tax software after years of TurboTax saving their data is equally daunting. This results in extremely low churn and a revenue stream that resembles an annuity. Wall Street and private equity firms place a much higher valuation multiple on $1 of low-churn recurring revenue than on $1 of volatile, project-based revenue. $1 that is highly likely to show up again next year is simply worth more than $1 that might not. This is why software-as-a-service SaaS companies with strong brands trade at such high multiples. Their business model is built on low churn and predictable, recurring subscriptions. The flip side of low churn is a high lifetime customer value, LTV. LTV is a prediction of the net profit attributed to the entire future relationship with a customer. A company that has to constantly acquire new customers has a low LTV. The customer might make one purchase and then disappear, but a company with a loyal following has a massive LTV. A customer who buys their first iPhone at age 18 might go on to buy a dozen more phones, multiple laptops, watches, and services over the next 50 years. The initial sale is just the beginning of a long and highly profitable relationship. A great brand acts as an LTV multiplier. Not only do customers stay longer, reducing churn, but they also tend to buy more over time. They trust the brand, so they are more receptive to new product offerings and services. An Amazon Prime member, for example, spends significantly more on the platform than a non-Prime member. The loyalty created by the Prime ecosystem increases the LTV of that customer dramatically. When you are analyzing a company, focusing on these metrics can be far more insightful than looking at last quarter's earnings. A company that is growing its revenue but has a high churn rate is in a precarious position. A company with slower revenue growth but a rock-solid, low-churn customer base with a high LTV is often a much better long-term investment. This financial reality, the stability and predictability that brand loyalty provides, is a goldmine for the long-term investor. It reduces risk. It creates a platform for steady, reliable growth. It allows a company to generate consistent profits that can be returned to shareholders through dividends and buybacks, fueling the engine of portfolio growth for years to come. There is no concept more central to Warren Buffett's investment philosophy than pricing power, yet it is a term that is often misunderstood. It is not merely the ability to raise prices. Any company can do that. True pricing power is the ability to raise prices consistently over time without losing a significant number of customers or market share. It is the ultimate litmus test of a great business, the definitive proof that a company possesses a durable competitive advantage. And there is no better story to illustrate this concept than Buffett's lifelong admiration for and monumental investment in the Coca-Cola Company. Buffett often frames the power of Coke with a simple thought experiment he poses to business school students. He asks them, if you were given $100,000, but in exchange you had to give up drinking Coca-Cola for the rest of your life, would you take the deal? A surprising number of them, even for that life-changing sum of money, would refuse. They can't imagine a future without their favorite soft drink. Then he flips the question, would you take the same deal for a generic store-brand cola? Every hand in the room goes up. People would gladly give up the no-name brand for free, let alone for $100,000. In that simple comparison lies the multi-hundred-billion-dollar secret of Coca-Cola's success. The company does not sell a beverage, it sells a feeling, a habit, a moment of refreshment that, in the minds of billions of people, has no substitute. This psychological monopoly gives it immense pricing power. Buffett's major investment in Coke came in 1988. He had been a fan of the product his entire life, famously drinking at least 5 cans a day. But he became a fan of the business after the stock market crash of 1987. The crash had indiscriminately punished all stocks, good and bad. For a brief period, one of the greatest businesses in the world was on sale. Buffett and Munger began to buy, ultimately investing over $1 billion to acquire roughly 7% of the company. It was a massive, concentrated bet. What did he see that others, in their panic, were missing? He saw the pricing power. He did the mental math. Coca-Cola sold hundreds of billions of servings of its products around the world each year. If they could raise the price of each serving by just a tiny fraction of a cent, that increase would be pure profit. It would flow directly to the bottom line, with no corresponding increase in costs. And because of the brand's incredible loyalty, customers would barely notice, or if they did, they would grumble for a moment and then pay it anyway. He saw a business that could protect its shareholders from the ravages of inflation. As the cost of sugar, aluminum, and labor went up over time, Coca-Cola could simply pass those costs, and then some, on to its customers. A lesser business in a competitive industry would have to absorb those costs and see its profit margins shrink. Coca-Cola could raise its prices at a rate greater than inflation, meaning its real inflation-adjusted earnings would continue to grow. This is the ultimate engine of long-term value creation. Since his investment in 1988, Coca-Cola has done exactly that. Through countless small price increases over 3 decades, the company has grown its earnings and dividends relentlessly. Buffett's initial $1 billion investment is now worth well over $20 billion, and that doesn't even count the tens of billions in dividends Berkshire Hathaway has received over the years. The story of Coca-Cola is the definitive case study in pricing power. It demonstrates that the single most important decision in evaluating a business is not what its earnings were last year, but what its power is to increase its earnings in the future. And that power is almost always a direct function of the strength of its brand. The reason pricing power is such a potent financial force is because of its ability to exploit a fundamental quirk in human cognition known as the anchoring bias. This bias describes our tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. Once an anchor is set, we interpret other information around it, and we are reluctant to move far away from that initial anchor point. Premium brands are masters of setting a high anchor. When a luxury automaker releases a new flagship model, they often announce the price of the top-of-the-line, fully loaded version first. That 6-figure price becomes the anchor. The lower-priced base models, while still expensive in absolute terms, seem reasonable by comparison. The same is true for a high-end restaurant that lists a $200 steak on its menu. Suddenly, the $60 fish entree seems like a bargain. Coca-Cola, through a century of marketing and consistent quality, has anchored its product not as a commodity beverage, but as a premium, iconic brand. The fair price for a Coke in our minds is not anchored to the price of water and sugar. It is anchored to the emotional benefit and the brand's perceived value. This high anchor gives them enormous latitude to adjust prices upwards over time without triggering a rational reevaluation from the consumer. For most people, buying a Coke is a small, habitual purchase. The decision is made on autopilot. They are not performing a cost-benefit analysis each time they approach a vending machine. Because the price increases are small and gradual, they happen below the radar of conscious thought. The new, slightly higher price becomes the new anchor for the next purchase, and the process repeats itself. This phenomenon is what creates price inelasticity of demand. In economics, inelastic demand is a situation in which the quantity demanded by consumers shows little response to a change in price. For a commodity product like gasoline or milk from a generic producer, demand is highly elastic. If one gas station raises its price by 10 cents a gallon, customers will flock to the station across the street. But for a product with a powerful brand and inelastic demand, a 10% price increase might only result in a 1 or 2% drop in volume. The net result is a massive increase in revenue and profit. The psychological reason for this inelasticity is that the brand has successfully shifted the purchase decision from the logical, price-sensitive part of the brain to the emotional, habit-driven part. We don't buy the product because it is cheap. We buy it because it fulfills a craving, reinforces a habit, or signals something about our identity. The price is a secondary consideration. This is a state of commercial nirvana for a company. It frees them from the tyranny of the competitive marketplace. They are no longer just competing on price. They are competing on a psychological battlefield where they have already built an unassailable fortress. An investor who can identify companies that have cultivated this kind of price inelasticity has found the key to unlocking extraordinary long-term returns. These are the businesses that can navigate economic cycles, fend off competitors, and relentlessly grow their earnings power, all because they have successfully anchored their value not in the cost of their materials, but in the minds of their customers. Translating the abstract concept of pricing power into a concrete, actionable investment tool requires a systematic checklist. We need a way to move beyond intuition and rigorously test a company's ability to command its price. This is the Pricing Power Scorecard, a 5-point diagnostic model designed to separate the true pricing powerhouses from the pretenders. The first and most important test is the Inflation Plus test. This is a historical analysis. Go back 10, 15, even 20 years and track the average selling price of the company's core product or service. Then compare the compound annual growth rate of that price to the average rate of inflation over the same period. A company that has only managed to raise its prices in line with inflation has no real pricing power. It is simply treading water, protecting its margins from rising costs. A true sign of pricing power is a consistent ability to raise prices at a rate bully jump to greater times than inflation. This demonstrates that the company is not just passing on costs, but is actively capturing a greater share of the value it creates for its customers. This inflation plus capability is the ultimate source of real, long-term earnings growth. The second diagnostic is what I call the grumble but pay phenomenon. This is a real-time test that you can observe whenever a company announces a price increase. Go to social media, forums, and news comment sections. Do you see a wave of customer outrage followed by mass cancellations and a switch to competitors? Or do you see a lot of grumbling and complaining, followed by a reluctant acceptance and continued payment? The latter is the unmistakable sound of a deep economic moat. Think of Netflix. Every time they raise their subscription price, there is a predictable chorus of online complaints. Yet, their subscriber numbers continue to grow. Customers grumble, but the prospect of losing access to their vast library of content and their personalized profiles is more painful than the extra dollar or two a month. This is pricing power in action. If a price hike leads to a genuine exodus of customers, the company's moat is shallow and its brand is weak. The third component is a deep dive into the company's gross margin analysis over at least a decade. As we've discussed, pricing power directly protects profitability. A company with true pricing power should exhibit two key traits in its gross margins. They should be consistently high, and they should be stable or expanding over time. High margins, generally above 40% and often much higher for software or luxury brands, indicate that the company has a significant buffer between its costs and its selling price. Stability in those margins, even during recessions or periods of inflation, indicates that the company is not being forced to compete on price. If you see a company whose gross margins are erratic or in a long-term decline, it's a major red flag that their competitive position is eroding. Fourth is what you might call the skimpflation resistance test. Skimpflation is the practice of shrinking the size or quantity of a product while keeping the price the same. It's a sneaky way to raise prices without officially raising prices. While many companies do this, the truly elite brands often don't have to. Because their customers are less price-sensitive, they have the confidence to implement a straightforward price increase on the exact same product. When you see a company proudly announcing new lower price, or now with 20% more, it is often a sign of weakness. They feel they have to bribe the customer to maintain their loyalty. The strongest brands can raise the price and deliver the exact same product, knowing their customers will stick with them. The final element of the scorecard is a simple but powerful thought experiment. Put yourself in the shoes of the CEO. If you were to announce a 10% price increase across the board tomorrow morning, what would honestly happen to your business? Would your largest customers immediately take calls from your competitors? Would you lose a significant portion of your market share by the end of the quarter? Be brutally honest. For a commodity steel producer, the answer is yes, it would be a disaster. For a company like Moody's, the credit rating agency, the answer is almost certainly no. Their customers need their ratings and have few, if any, credible alternatives. The ability to answer no to that question is the very definition of a wonderful business. By systematically applying this 5-point scorecard, you can objectively assess a company's pricing power. It forces you to look at historical data, real-world evidence, financial trends, and the fundamental competitive landscape. It is the closest thing we have to a field guide for identifying the world's most profitable and durable businesses. For every company that successfully cultivates pricing power, there are 99 others trapped in a brutal and unwinnable war. The antithesis of pricing power is the race to the bottom, a strategic mindset that infects entire industries and destroys shareholder value with ruthless efficiency. This is the world of the commodity business, and it is a place where investors should tread with extreme caution. A commodity business is one where the product or service is largely undifferentiated from its competitors. The customer perceives little to no difference between one company's offering and another's. Think of basic agricultural products like wheat, industrial materials like concrete, or services like basic data storage. In this environment, the customer's purchase decision is almost entirely driven by one factor: price. Because there is no brand loyalty or unique feature to command a premium, the only available competitive lever is to be the cheapest. This creates a destructive cycle. Company A lowers its price to gain market share. Company B is then forced to match that price or lower its own to remain competitive. Company C follows suit. This downward price pressure continues until the profit margins for the entire industry are squeezed down to subsistence levels, or in many cases, to zero. The companies are essentially trapped, running faster and faster on a treadmill just to stay in the same place. An investor who doesn't understand the concept of pricing power might look at these companies and see a bargain. They often trade at low price-to-earnings (PE) or price-to-book (PB) ratios. They look statistically cheap. The investor thinks they've found a hidden gem. What they've actually found is a value trap. The low valuation is not an oversight by the market. It is an accurate reflection of a terrible business model. The company's earnings are volatile and unpredictable. entirely at the mercy of the industry's pricing cycle. There is no moat to protect them. The airline industry, as previously mentioned, is a classic example of this race to the bottom, but it extends to many other sectors. Think of the personal computer industry in the 1990s and 2000s. With the exception of Apple, which cultivated a premium brand in its own ecosystem, the rest of the industry was a bloodbath. Companies like Dell, HP, and Gateway were locked in a constant price war over functionally identical beige boxes running the same Microsoft Windows operating system. Their margins were razor thin, and many once great names eventually went bankrupt or were acquired for pennies on the dollar. The investor who focuses on the path of the 99% is drawn to the siren song of cheapness. They buy the struggling retailer because it's trading below book value, not realizing that its customers have no loyalty and are fleeing to more efficient online competitors. They buy the generic drug manufacturer after its patent expires, not realizing its product has become a commodity and its pricing power has vanished overnight. They fail to understand that in business, as in life, you often get what you pay for. A cheap stock is usually the sign of a troubled company in a brutal industry. A stock that appears expensive on a superficial basis may, in fact, be an incredible bargain if it belongs to a business with a durable pricing power to grow its earnings for decades to come. The race to the bottom is a game that is rigged against the investor. The only winning move is not to play. The financial magic of pricing power lies in its direct and explosive impact on a company's free cash flow, which is the ultimate driver of shareholder returns. The connection is a matter of simple but powerful arithmetic, amplified by the principle of operating leverage. Let's construct a simple model to illustrate this. Imagine a company, Brandco, that has a strong economic moat and true pricing power. Brandco generates $100 million in revenue. Its cost of goods sold, COGS, is $40 million, giving it a gross profit of $60 million or a 60% gross margin. Its selling, general, and administrative (SG&A) expenses are $30 million. This leaves an operating profit of $30 million. Now, let's say Brandco's management, confident in their brand's loyalty, decides to implement a modest 5% price increase across all its products. Because demand is inelastic, we'll assume they lose no sales volume. Their revenue now jumps to $105 million. Here is where the magic happens. What happens to their costs? Their COGS, the direct cost of producing the goods, remains the same at $40 million. Their SG&A expenses also remain the same at $30 million. They didn't need to hire more salespeople or open new headquarters to implement the price change. The entire $5 million in additional revenue from the price increase flows directly down to the operating profit line. Their operating profit jumps from $30 million to $35 million. Think about that. A 5% increase in revenue resulted in a 16.7% increase in operating profit, $5 million divided by $30 million. This is the power of operating leverage. Because many of a company's costs are fixed, each incremental dollar of revenue from a price increase comes at a very high margin. In this case, a 100% margin. This profit then converts into a surge of free cash flow. This excess cash can then be used to fuel portfolio growth for shareholders in several ways. The company can increase its dividend, providing a direct cash return to investors. The dividend growth rate of a company with pricing power can often far outpace its revenue growth rate. They can also use the cash to buy back their own stock. This reduces the number of shares outstanding, which makes each remaining share more valuable and automatically increases earnings per share, EPS. Or they can use the cash to acquire other businesses, as Berkshire Hathaway does, further expanding their earnings power. Now, contrast Brandco with Commodity Co., a business in a competitive, price-sensitive industry. Commodity Co. also has $100 million in revenue, but its gross margin is only 20%, reflecting its lack of pricing power. Its operating profit is much lower. If Commodity Co. tries to raise prices by 5%, its customers will flee to competitors. It has no operating leverage to exploit. In fact, it often experiences negative leverage, where a small drop in price to remain competitive can wipe out its entire profit. This simple model reveals why Buffett is so obsessed with pricing power. It is the single greatest lever a company can pull to create shareholder value. It is a direct pipeline from brand loyalty to free cash flow. An investor who learns to identify the companies that possess this pipeline and who has the patience to hold them for the long term is tapping into one of the most powerful and reliable wealth creation machines the financial world has ever known. It is the secret ingredient that transforms a good investment into a truly life-changing one. No competitive advantage, no matter how powerful it seems, is guaranteed to last forever. Brands, like castles, must be constantly defended and maintained, or they will inevitably crumble. This brings us to a crucial and often overlooked chapter in the Buffett playbook: the recognition that moats can, and do, dry up. The investor who fails to monitor the health of a company's brand is practicing a dangerous form of buy and forget, a misinterpretation of Buffett's long-term philosophy. The perfect illustration of this principle is Buffett's own multi-decade journey with the newspaper industry, specifically his celebrated investment in the Washington Post. In the 1970s, a major metropolitan newspaper was one of the greatest businesses imaginable. It possessed a near-monopolistic franchise in its local market. If you were a resident of that city, you had to read that paper to know what was going on in your community: local politics, sports, obituaries. If you were a local business, you had to advertise in that paper to reach your customers. There was no other game in town. This local monopoly gave newspapers incredible pricing power. They could raise their subscription and advertising rates year after year, and their customers had no alternative. It was a business with a deep, seemingly unbreachable economic moat. Buffett recognized this early on. In 1973, he invested about $11 million in the Washington Post Company. The company was run by a brilliant and courageous manager, Katharine Graham, and its brand was synonymous with journalistic integrity, especially after its role in breaking the Watergate scandal. The investment was a home run. The Post, like other newspapers, gushed cash, and Buffett's stake grew to be worth over $1 billion. For decades, it was a textbook example of a wonderful business with a durable brand. But then came the internet. Slowly at first, and then with brutal speed, the internet began to drain the newspaper's moat. Craigslist took away the lucrative classified advertising business. Websites offered news for free, instantly, 24/7. Social media became the new town square. The newspaper's monopoly on information and advertising was shattered. The brand of the Washington Post still stood for quality journalism, but the business model that supported it was disintegrating. Buffett, ever the realist, watched this happen with a clear eye. He didn't fall in love with his own story. He didn't cling to the past glory of the industry. In his annual letters to shareholders, he began to write with increasing candor about the dismal economics of the newspaper business. He acknowledged that the franchise was broken, the pricing power gone. In 2014, he finally sold Berkshire's entire portfolio of newspapers. It was the end of an era. The story is a powerful lesson. Buffett's genius was not just in identifying the moat in the 1970s. It was in recognizing that the moat was disappearing in the 2000s. He understood that true long-term investing is not a passive activity. It is a state of constant vigilance. You must continually ask the question: is the competitive advantage that I originally identified still intact? Is it growing stronger or weaker? The world changes, technology disrupts, and consumer habits evolve. The brand that was dominant yesterday can become a relic tomorrow. The failure of great companies to maintain their brand dominance is rarely a sudden event. It is a slow, creeping decay, often enabled by two insidious psychological biases that afflict management and investors alike: the normalcy bias and the ostrich effect. Understanding these biases is critical for any investor who wants to avoid riding a once-great brand all the way to the bottom. The normalcy bias is our natural human tendency to underestimate the possibility of disaster and to assume that things will continue to function in the future the way they have in the past. When a company has been a market leader for 50 or 100 years, its executives and its long-term shareholders can become dangerously complacent. They see a long, uninterrupted history of success and project it indefinitely into the future. The idea that a fundamental, disruptive change could render their business model obsolete seems preposterous. This was the mindset at Kodak for decades. They were the undisputed kings of photography. The Kodak brand was synonymous with capturing memories. It was a beloved, trusted institution. When digital photography emerged, Kodak's management saw it not as an existential threat, but as a novelty. Their entire business, from chemical manufacturing to film processing, was built around the old way of doing things. The normalcy of their past success blinded them to the reality of the future. They couldn't imagine a world without film, because a world without film was a world without Kodak as they knew it. This normalcy bias created a fatal institutional inertia. Closely related is the ostrich effect, which is the cognitive bias of avoiding negative information by sticking one's head in the sand. When confronted with data that is threatening or unpleasant, our instinct is often to ignore it, deny it, or rationalize it away. We actively avoid the information that could cause us psychological discomfort. The executives at Blockbuster Video were masters of this. As Netflix began to gain traction, first with its DVD by mail service and then with streaming, the threat to Blockbuster's retail-based model was obvious to many outsiders. But inside the company, the ostrich effect took hold. They dismissed Netflix as a niche player. They rationalized that people enjoyed the experience of browsing in a physical store. They ignored the mounting evidence that their business model, built on the inconvenience of late fees, was deeply unpopular with customers. They stuck their heads in the sand, hoping the internet threat would just go away. It didn't. For investors, these two biases create a powerful trap. We buy a stock because of its great historical brand and track record. Then, when the business starts to show signs of decay, slowing growth, eroding margins, new competitive threats, the normalcy bias tells us, don't worry. It's just a temporary setback. This is a great company. It will bounce back. The ostrich effect tells us to stop reading the negative news articles and to focus only on the company's reassuring press releases. We become anchored to the past, unable to accept the new reality. This is how investors end up holding stocks like Sears, General Electric, or IBM for years, even decades, as they slowly bleed value. They fell in love with the brand's history instead of conducting a cold, objective analysis of its future. Buffett's sale of his newspapers shows a mind that is immune to these biases. He is a forward-looking realist. He understands that no brand is entitled to its market position. Loyalty is earned every single day, and the moment a company stops earning it, or the moment the world changes in a way that makes that loyalty irrelevant, the investor must be prepared to act. To avoid the fate of the complacent investor, you must become a vigilant moat watcher. You need an early warning system, a set of tools to detect the subtle signs of brand decay long before they become a full-blown crisis reflected in the stock price. This is the Moat Erosion Detection System, a 5-part framework for actively monitoring the health of your investments' competitive advantages. The first component is to monitor the narrative. A brand exists in the cultural conversation. You must pay attention to how that conversation is changing. What is the language people use when they talk about the brand? Is it still associated with positive, forward-looking concepts like innovation, quality, and desire? Or is it increasingly described with words like reliable, old-fashioned, or, worst of all, nostalgic? Use tools like Google Trends to track search interest in the brand versus its competitors. Use social media sentiment analysis to gauge public perception. A shift in the cultural narrative is often the first, most subtle sign that a brand is losing its connection with the present. The second step is to track the share of mind, especially with younger generations. A brand that is not capturing the loyalty of new customers is a brand that is slowly dying. It is living on the fumes of its past glory. You must investigate. Who is the brand's core customer today? Is that demographic growing or shrinking? Is the brand still the default aspirational choice for people entering the market for the first time? The decline of many legacy department stores began when they lost their connection with young shoppers, who saw them as places their parents or grandparents shopped. A brand that becomes your parents' brand is on a dangerous trajectory. The third indicator is the brand extension red flag. When a company with a strong, focused brand starts to dilute its meaning by slapping its logo on a wide array of unrelated and often lower-quality products, it is a sign of trouble. This is often a short-term strategy to chase revenue at the expense of long-term brand equity. The classic example is the fashion designer Pierre Cardin, who in his later years licensed his prestigious name to thousands of products, from frying pans to cigarettes. This overexposure destroyed the brand's exclusivity and prestige. When you see a company pursuing what looks like a desperate brand stretch, ask yourself if they are strengthening the core brand or simply milking it for its remaining value. The latter is a sign that management has lost confidence in the core business. Fourth, you must scrutinize management's capital allocation. A brand is a living asset that requires constant investment to stay relevant. Look at where the company is spending its money. Are they reinvesting heavily in research and development to create better products? Are they investing in modern marketing to connect with new audiences? Are they improving the customer experience? Or are they cutting these discretionary expenses to meet Wall Street's short-term quarterly earnings estimates? A management team that consistently starves its brand of investment to prop up short-term profits is effectively selling the company's future to pay for its present. Finally, pay attention to the competitor's gaze. Don't just analyze the company's traditional, established rivals. Look for the small, nimble startups that are attacking a specific niche of the brand's customer base. These disruptors often win by telling a better story, offering a superior customer experience, or leveraging a new technology. The threat to Gillette didn't come from Schick, it came from Dollar Shave Club. The threat to legacy banks isn't just other legacy banks, it's a host of fintech startups. Where the most innovative competitors are focusing their energy is a powerful leading indicator of where an incumbent brand's moat is most vulnerable. By regularly applying this 5-part system, you transform from a passive stockholder into an active business owner. You are doing the continuous work required to ensure that your investments' moats are not just intact but are hopefully growing wider every year. The greatest mistake an investor can make after finding a wonderful, brand-driven business is to fall for the buy-and-forget myth. This is a dangerous oversimplification of Warren Buffett's long-term investing philosophy. People hear his famous quote, "Our favorite holding period is forever," and they interpret it as a license for intellectual laziness. They believe that the initial work of identifying a great company is the only work required. They buy a blue-chip stock with a legendary brand name, put the stock certificate in a drawer, and assume their work is done. This approach is the path of the 99%, and it is a recipe for eventual disappointment. True long-term, value-oriented investing is not passive. It is not buy and forget. It is buy and verify. The world is not static. It is a dynamic, chaotic, and relentlessly competitive place. Technology disrupts, consumer tastes shift, and new competitors emerge from unexpected places. The economic moat that was a mile wide a decade ago can be a narrow stream today. The investor who is not paying attention will be the last to know. Think of the investor who bought IBM stock in the 1960s. At the time, IBM was the quintessential one-stock portfolio. It was utterly dominant in the mainframe computer industry. Its brand was a global symbol of technological supremacy. The buy-and-forget investor would have held that stock for the next 50 years, feeling secure in their choice. But they would have missed the tectonic shifts in the technology landscape. The rise of the personal computer, the dominance of Microsoft's operating system, the explosion of the Internet, the shift to mobile and cloud computing. IBM, a giant corporation with immense inertia, struggled to adapt to each of these waves. While it survived, its dominance faded, and its stock performance for long stretches was mediocre at best. The vigilant buy and verify investor would have periodically reevaluated their thesis. They would have asked, is IBM's moat in the world of distributed computing as strong as it was in the world of mainframes? Is their brand still synonymous with innovation in the eyes of the next generation of developers and entrepreneurs? The honest answer, for long periods, would have been no. The buy and forget myth leads to a portfolio that becomes a museum of once great companies. It becomes cluttered with names that were titans in a bygone era but are now struggling for relevance. The investor becomes anchored to the past, holding on out of misplaced loyalty or an unwillingness to admit that their original thesis is no longer valid. They end up riding the stock all the way down, watching decades of potential gains evaporate. Buffett's holding period is forever, only as long as the company continues to meet his stringent criteria of being a wonderful business with a durable and growing competitive advantage. He and his team at Berkshire Hathaway are constantly verifying. They are reading, learning, and assessing whether the moats of their businesses are widening or narrowing. When they concluded the moat of the newspaper industry was narrowing, they sold. Their loyalty is not to the stock, but to the principle of investing in durable competitive advantages. Abandon the myth of buy and forget. Embrace the discipline of buy and verify. Your role as a long-term investor is not to be a passive spectator, but to be a vigilant, lifelong business analyst. The slow erosion of a brand's power is not just a qualitative story. It's a quantitative process that leaves a clear trail of evidence in a company's financial statements. For the vigilant investor, learning to read these signs is like a doctor learning to spot the early symptoms of a disease. The first sign often appears on the top line: slowing revenue growth. A dominant brand with pricing power can consistently grow its revenue at a healthy clip. When that growth rate begins to decelerate, year after year, it's a warning sign. It may indicate that the market is saturated, but more often it signals that the brand is losing its appeal and new customers are becoming harder to attract. Next, to combat this slowing growth, management will often make two desperate moves that show up in the income statement. First, they will increase their spending on sales and marketing as a percentage of revenue. They are having to spend more and more to acquire each new customer, a sign of declining marketing ROI. Second, they may start to discreetly or overtly cut prices through promotions and discounts to prop up sales volume. This leads to the next, more serious symptom: shrinking margins. You will see the company's gross margin begin to decline as they lose pricing power. You will also see their operating margin shrink as their marketing costs increase. The profitability of the business is being squeezed from both ends. Perhaps the single most important metric for tracking the health of a moat is return on invested capital, or ROIC. ROIC measures how efficiently a company is using its capital to generate profits. A truly great business with a strong brand can generate high and sustained returns on capital because its most valuable asset, the brand, doesn't require massive capital investment. When you see a company's ROIC begin a steady, multi-year decline, it is one of the strongest possible signals that its competitive advantage is eroding. The business is becoming less profitable and less efficient. It is having to work harder and invest more capital just to generate the same level of profit as before. To mask these underlying problems, a management team might turn to financial engineering, which leaves clues on the balance sheet and cash flow statement. They might take on more debt to fund aggressive share buyback programs. On the surface, this can make earnings per share (EPS) look good as the number of shares decreases. But the business itself isn't actually healthier. The increase in leverage makes the company more fragile and risky. By learning to connect the narrative of a brand's decline with these specific financial indicators, you can protect yourself from value traps. You can see the story the numbers are telling, a story that often contradicts the optimistic press releases from the company. The financial statements are the final arbiter. They are where the fuzzy concept of brand decay is translated into the unforgiving language of financial reality. A great investor must be fluent in both. The entire philosophy we have deconstructed, the focus on brands, on pricing power, on moats, is not about finding a single clever stock pick. It is about a comprehensive strategy for building a machine for compounding wealth over a lifetime and beyond. The ultimate foundational anecdote for this is not a single transaction, but the entire history of Berkshire Hathaway itself. The story begins with a colossal mistake. In the 1960s, a young Warren Buffett bought a controlling stake in a struggling New England textile mill called Berkshire Hathaway. He bought it because, by the quantitative metrics of his mentor Ben Graham, it was cheap. It was a classic cigar butt, a terrible business trading for less than the value of its assets. He thought he could squeeze one last puff of profit out of it. It was, in his own words, a monumentally stupid decision. The textile business was a brutal commodity industry with intense foreign competition. It was a race to the bottom. The business bled cash and consumed enormous amounts of capital just to stay afloat. It was the antithesis of everything we have discussed. The profound genius of Warren Buffett was not in buying Berkshire Hathaway, but in what he did next. He recognized his mistake, and instead of trying to fix the unfixable textile business, he began to use what little profit it generated as a base to buy other, better businesses. He began to transform Berkshire from a failing manufacturer into a holding company, a museum for wonderful businesses. His first major acquisitions in the insurance industry provided him with float, premium dollars he could invest for Berkshire's benefit. And what did he buy with that float? He bought businesses like See's Candies, he bought American Express, he bought the Washington Post, he bought Coca-Cola, he bought Geico. One by one, he added companies with powerful brands, unshakable customer loyalty, and immense pricing power to his collection. The cash generated by these incredible capital-light businesses was then used to buy more of the same. It created a powerful, self-reinforcing flywheel. The profits from the chocolates bought the soft drinks. The profits from the soft drinks bought the insurance. The profits from the insurance bought the railroads. Berkshire Hathaway became a financial fortress, a diversified conglomerate of companies, each with its own deep economic moat. The original, failing textile business was eventually shut down, but its name lived on, a constant reminder of the crucial lesson Buffett learned. It is far better to buy a wonderful business at a fair price than a fair business at a wonderful price. The story of Berkshire is the ultimate proof of the brand-based investment philosophy. It is a testament to the power of assembling a portfolio of these cash-generating machines, and then having the patience and discipline to let them work their magic for decade after decade. It is the blueprint for translating the identification of great brands into the creation of generational wealth. The reason so few investors are able to replicate Buffett's success, even though his methods are widely known, comes down to a final powerful psychological barrier: hyperbolic discounting. This is the cognitive bias that leads humans to strongly prefer smaller, immediate rewards over larger, delayed rewards. We are wired for the short term. We would rather have one marshmallow today than 2 marshmallows tomorrow. This instinct was useful for our ancestors on the savannah where the future was uncertain. But in the world of long-term investing, it is a catastrophic flaw. Hyperbolic discounting is what drives the destructive behavior of the average investor. They crave the immediate gratification of a hot stock that might double in a few months. The idea of buying a boring blue-chip stock and holding it for 30 years to achieve a much larger but much more delayed reward feels emotionally unsatisfying. It requires a level of patience and deferred gratification that our brains are not naturally equipped for. Financial media and Wall Street are structured to exploit this bias. The constant ticker tape, the breaking news alerts, the daily analyst upgrades and downgrades, all of it is designed to create a sense of urgency and to provoke action. It encourages us to think in terms of days and weeks, not years and decades. It makes us feel that we need to do something right now to get that immediate reward. Buffett's true genius is not just his ability to analyze businesses. It is his almost superhuman ability to override this deep-seated psychological bias. He has cultivated a mind that operates on a different timescale than the rest of the world. When he buys a stock, he is not thinking about what it will do next quarter or next year. He is thinking about the earnings power the business will have 10, 20, or 50 years from now. He is willing to endure years of the stock price going nowhere, as long as he believes the underlying value of the business is growing. He is willing to accept the small, immediate pain of underperforming a hot market in exchange for the massive, delayed reward of long-term compounding. He is playing a fundamentally different game. The average investor is playing checkers, reacting to the opponent's last move. Buffett is playing three-dimensional chess, thinking dozens of moves ahead. This ability to delay gratification is the final, and perhaps most important, psychological principle behind his success. He understands that the real money in investing is not made in the buying or the selling, but in the waiting. It is in harnessing the inexorable, exponential power of compounding, a force that only reveals its true magic over very long periods of time. An investor who can conquer their own innate impatience, who can learn to ignore the short-term noise and focus on the long-term signal, has adopted the mindset necessary to truly benefit from the strategy of owning wonderful, brand-driven businesses. So how do you translate this entire philosophy into a concrete strategy for your own capital? The final blueprint is the Fortress Portfolio Construction, a method for building a resilient, long-term portfolio designed to harness the power of compounding. It is a 5-step process that emphasizes discipline, patience, and a business owner's mindset. First is the core and satellite approach. The vast majority of your investment capital, say 60 to 80%, should form the core of your portfolio. This core should consist of a concentrated number of truly wonderful businesses, perhaps 5 to 15 companies, that you have identified through the rigorous analysis we've discussed. These are your blue-chip stocks with deep economic moats, powerful brands, and proven pricing power. These are your hold for a decade or more compounders. The satellite portion of your portfolio can be used for other assets, like index funds for diversification or more speculative investments, but the core is the engine of your long-term wealth creation. Second is the reinvestment mandate. This is non-negotiable. You must commit to automatically reinvesting every single dividend you receive from your core holdings. The dividends paid by companies with strong pricing power tend to grow consistently over time. By reinvesting them, you are buying more shares of these excellent businesses, which will then pay you even more dividends in the future. This creates a virtuous, compounding cycle. It is what Charlie Munger calls the Lollapalooza effect, where multiple positive factors work together to create an explosive, non-linear outcome. Reinvesting your dividends is the fuel for this explosion. The third principle, and arguably the most difficult, is the do-nothing discipline. Once you have constructed your core portfolio of wonderful businesses, your primary job is to let them work. Resist the urge to constantly tinker. Do not sell your winners just because their stock price has gone up. Do not panic and sell during inevitable market crashes. The only reason to sell a core holding is if your buy and verify process reveals that its fundamental economic moat is deteriorating. Otherwise, your job is to be patient and allow the power of compounding to work its magic over decades. Inactivity for the long-term investor is a strategic weapon. Fourth, you must learn to measure by look-through earnings. Stop obsessing over the daily fluctuations of your portfolio's market value. Instead, focus on what you truly own. Calculate your proportional share of the underlying earnings of the businesses in your portfolio. For example, if you own 1/1,000,000th of a company that earns $10 billion a year, your look-through earnings are $10,000. As these great brands grow their profits year after year, your share of those profits will grow, regardless of what the stock market is doing in the short term. This simple mental shift reframes your perspective from that of a nervous stock picker to that of a calm, confident business owner. Finally, the ultimate goal is to plan for succession. True generational wealth is not about what you accumulate in your own lifetime, but about what can continue to grow for your children and grandchildren. This involves not only structuring your assets in an efficient way through trusts or other estate planning vehicles, but also, and more importantly, passing on the financial education and the mindset. Teach your heirs not just about the assets they will inherit, but about the principles that were used to acquire them. This ensures that the fortress you have built will not be dismantled by the next generation, but will continue to compound, providing financial security and freedom for decades to come. The greatest enemy of the long-term investor is not a bear market or a recession, it is their own deep-seated need for action. The antithesis of the disciplined, patient approach we have outlined is the cult of action, a pervasive mindset that dominates the modern financial world and dooms the vast majority of investors to mediocrity. Members of this cult believe that to be a good investor, you must be constantly busy. They start their day by checking the pre-market futures. They watch financial news channels that are designed to create a sense of breathless urgency. They have alerts set on their phones for every stock they own. They read endless analyst reports, most of which are short-term noise. They feel a compulsion to trade, to react, to asterisk, do something in response to every piece of news. This constant activity is fatal to long-term returns for several reasons. First, it ensures that you will interrupt the process of compounding. Compounding works its magic over long, uninterrupted periods. By constantly trading in and out of positions, you are repeatedly resetting the clock. You never give the oak tree a chance to grow. Second, it incurs significant costs. Every trade generates a commission. Every profitable trade generates a tax liability, often at the higher short-term capital gains rate. These costs act as a constant drag on your performance, a self-inflicted wound that slowly bleeds your portfolio. Third, and most importantly, it forces you to make decisions based on emotion and short-term information. The human brain is not wired to make rational, long-term decisions in the face of a constant stream of stimulating but ultimately meaningless news. The cult of action leads to buying high in a moment of euphoria and selling low in a moment of panic. It is a perfect recipe for underperformance. The path of the 99% is a path of frantic activity. It is a path of chasing hot tips, of trying to time the market, of reacting to headlines. The investor is like a hyperactive child in a room full of switches, constantly flipping them on and off, and wondering why the lights never stay on for long. Buffett's path is the path of strategic inactivity. It is the path of a master gardener who, after carefully selecting the right seeds and planting them in fertile soil, has the wisdom to step back and let them grow, intervening only to pull the occasional weed. It requires discipline. It requires patience. It requires a deep understanding that in the world of long-term investing, your greatest profits will often come not from your brilliant actions, but from your brilliant inaction. The ultimate financial consequence of adopting this entire framework of focusing on brands, pricing power, and long-term compounding is not just a slightly better return. It is the difference between linear progress and exponential liftoff. It is the key that unlocks a completely different financial future. To make this tangible, let's look at a simple, powerful quantitative demonstration. Imagine 3 investors, each starting with $10,000 at age 30, and each investing for 30 years until age 60. Investor A follows the path of the 99%. They are a member of the cult of action, constantly trading, chasing fads, and owning a portfolio of average commodity-like businesses. Due to costs, taxes, and poor timing, their net annual return is 6%. Investor B is smarter. They simply buy a low-cost S&P 500 index fund and hold it. They capture the market's return, which we'll assume is a historical average of 8% per year. Investor C is the one who has absorbed the lessons we've discussed. They build a concentrated fortress portfolio of a handful of wonderful brand-driven businesses with durable pricing power. Because these businesses can consistently grow their earnings at an above-average rate, this investor achieves a 12% annual return over the long term. For the first few years, the difference between the three is not dramatic, but the magic of compounding is a backloaded phenomenon. After 30 years, let's look at the results. Investor A, at 6% per year, turns their $10,000 into approximately $57,000, a respectable result, but not life-changing. Investor B, the index fund investor, at 8% per year, ends up with just over $100,000. A good outcome, and a testament to the power of simple, passive investing. But Investor C, the Buffett-style business owner, experiences a different reality. At a 12% annual return, their initial $10,000 grows to nearly $300,000. That is almost 3 times the result of the index fund investor and over 5 times the result of the active trader. The seemingly small 4% difference in annual return did not create a 4% difference in the outcome. It created a 200% difference. This is the mathematical certainty of exponential growth. This is the direct financial connection, the ability to identify that one critical factor, durable pricing power rooted in a powerful brand, is the single greatest lever you can pull to change your long-term financial trajectory. It is the force that bends the curve of your wealth upwards. It is the engine that drives you from financial security to true financial freedom. It is the final, tangible promise of this entire philosophy. You have just invested a significant amount of your most valuable asset, your time, to rewire the way you look at the world of business and investing. You have moved beyond the superficial language of stock prices and quarterly earnings, and have begun to learn the secret language of brand, loyalty, and pricing power. This is not just another piece of financial advice. It is a fundamental mental model, a new operating system for making capital allocation decisions. You now possess the framework that allowed Warren Buffett to identify the cash-generating machines that built his empire, a tool that can help you distinguish the fleeting fads from the durable fortresses. This is a powerful advantage, a lens that allows you to see the invisible assets that 99% of market participants will always overlook. But what you've just mastered is a single crucial pillar in a much larger architecture. Buffett's system of thought is not a collection of isolated tricks, it is a deeply interconnected network of mental models. The ability to identify a great brand is powerful, but its true potential is only unlocked when it is combined with the discipline of knowing when to buy it, the wisdom of valuing it correctly, and the courage to act decisively when the opportunity presents itself. You've learned how to identify the what, but that is only one part of the map. The journey now leads to understanding the when and the how much. And that next piece of the map, the critical link that connects the quality of a business to the price you should be willing to pay for it, is what separates the admirer of great companies from the owner of them. The video that is now on your screen is designed to be that very link. It is the next step in this logical chain, the component that builds directly upon the foundation you have just laid. To click away now would be like learning how to identify gold ore but never learning the process of how to extract the gold itself. The ascent to true financial mastery is a step-by-step process of assembling a complete mental arsenal. You have just forged a powerful new weapon. The only choice now is whether you will leave it isolated or whether you will continue the climb and learn how to integrate it into the complete system. This next click is not about watching another video. It is a commitment to completing your education. It is a decision to move from being a student of the game to becoming a master of it. Continue your ascent.